Amidst a sea of headlines, it's easy to get caught up in the short-term market movements. Yet beneath the surface lies a depth of opportunity and insight. That's when diligent analysis and strategic foresight remain paramount, and that's the cornerstone of our approach. I'm Mark Kinney, Chief Investment Officer with Newport Private Wealth. In this video, I'll be recapping some of the actions we took in the fourth quarter and how Newport navigated through the turbulence of 2023. I'll also share our perspective on how the first quarter of 2024 is unfolding and what we're watching closely. The past year has been a tale of resilience and uncertainty. We've steered through inflation concerns, tight labor markets, and geopolitical tensions. All have put global market stability to the test. Our investment decisions have been carefully calibrated in response to these market conditions. 2023 was a year of active engagement and deliberate positioning. Newport's 5 mandates returned between 3.29% and 4.29% in the fourth quarter. This reflects our proactive and nuanced approach to asset allocation and investment selection. Here are some highlights of the actions we took to protect and build your wealth. Let's start with public yield. The fourth quarter brought a Goldilocks scenario, not too hot, not too cold with respect to inflation. With core numbers showing improvement and growth still positive, the Federal Reserve signaled a pause in rate hikes. This pause sparked a rally across all risk assets and was a particularly strong catalyst for the bond market. Bonds saw a significant rebound, reversing a long period of underperformance. The FTSE Canada Universe Bond Index rose 6.69%, highlighting the attractiveness of bonds in a falling rate environment. After a long period of being underweight bonds due to negligible returns, 2023's higher yields led us to increase our allocations to this asset class by $122 million. We've added more in 2024 and will continue to do so as opportunities arise. Newport's investments in private debt, mortgages, real estate, private equity, and infrastructure all provided positive returns in 2023. However, these were at lower levels than previous years, as higher interest rates impacted growth within some of these asset classes negatively. Rising interest rates have been a boon to our yield-oriented private asset classes. The private debt portfolio, heavily weighted towards senior secured floating rate loans, has thrived in this environment. It delivered high single-digit yields throughout 2023. At the same time, our mortgage portfolio, mainly consisting of first mortgages on stabilized real estate, also saw benefits from higher interest rates. We will continue replacing these first mortgages with new, higher-yielding mortgages while maintaining the same risk profile. This part of the portfolio is managed by more than 15 specialized, independent managers, showcasing our commitment to broad-based, expert-driven investment strategies. One area that was nominally affected by high interest rates in the fourth quarter was our private real estate holdings. Even so, they continued to provide steady rental income. During the quarter, we partnered with an experienced manager to acquire properties in Florida and Texas at well below market prices. In total, we allocated $65 million to private real estate in 2023. Infrastructure investments delivered steady returns. Notably, our largest position in Brookfield Supercore Infrastructure LP hit the high end of its expected return range. On the public equity front, the dramatic drop in Treasury yields wasn't just a number, it was a signal, sparking an equity market rebound that finally broadened. The public equity market narrative has been dominated by the Magnificent Seven. The market cap of these tech giants now surpasses the combined stock market value of Japan, the UK, France, Canada, and China. Yet we should remember that it wasn't until December 2023 that both the NASDAQ and S&P 500 clawed their way back to levels last seen in January 2022. This underscores the dynamic nature of the equity markets. Today's leaders were yesterday's laggards and can quickly become tomorrow's underperformers. As the fourth quarter unfolded, we saw a more inclusive rally. The small-cap-focused Russell 2000 index posted a remarkable 24.3% return over the last 9 weeks of the year, signaling a resurgence of investor interest across the board. Perhaps even more telling was the performance of the equal-weighted S&P 500 index, which outperformed the market cap-weighted index in the fourth quarter. This improvement in equity market breadth is a promising sign, pointing towards a potentially more robust and sustainable rally. We seized the market bottom after the public equity sell-off, allocating $75 million in the fourth quarter, focusing on high dividend-paying Canadian companies. 2023 was also a year where holding cash provided attractive, risk-adjusted returns thanks to Newport's preferred rate on uninvested cash of prime less 2%, which currently yields 5.2%. As we anticipate interest rate cuts, we're strategizing to implement investment plans for any excess cash. Our focus is on long-term growth over temporary shelters. The path forward is not without its risks. Our investment platform is designed to be nimble, to adapt to these changing conditions, ensuring we're always protecting your capital. Here are some early thoughts about the year ahead. Public stock markets move in waves. After a strong Q4 and a decent start to 2024, we were prepared if equity markets pull back. We're looking beyond the near-term cycles and focused on investing in high-quality companies, trading at favorable valuations while maintaining a long-term view. The equity markets landscape continues to evolve. The broader market's participation in the recent rally suggests a momentum shift that is to be expected. Diversification beyond the tech behemoths offers new opportunities for growth and resilience in the face of market volatility. We continue to put money to work with additional allocations to our fixed income and equity managers. From where we sit today, rate cut expectations are shifting to the back half of 2024 based on signals from the Fed funds futures and recent inflation data. Inflation has been a central theme in our analysis. The potential for inflation to resurface or for rates to stay at elevated levels remains a risk and a concern as evidenced by current data. While we've seen meaningful progress in bringing inflation closer to target levels, challenges remain with wage inflation and tight labor markets. Until these are at target levels, we expect bouts of volatility to remain. Our strategic adjustments and diversified approach across public yield, private yield, and growth investments ensure stability and opportunity. With a keen eye on the evolving market dynamics, we're poised to continue delivering value and growth for our clients with these asset classes. Our commitment at all times is to navigate complexity with expertise and foresight. We're not just managing your investments, we're safeguarding your future, ensuring that whatever the economic climate, you're positioned to thrive. We are honored to be the guardians of your wealth and prosperity. It is a responsibility we uphold proudly.